Now is Doug Murphy, President and CEO of Corus Entertainment. Doug, thanks so much for joining us today.
Good to be here, Jacqueline.
So this decision to sell off this part of your business, can you just break it down for us? Why now?
Well, last summer we began a complete review of our operating model and an enterprise cost review. We saw the advertising recession looming, and it was an opportunity to really look at our asset base and see if there's opportunities to rationalize the asset base. So that began a conversation about core and non-core. And Toon Boom has been a remarkable investment for our company. It began back in 2004, about half of it. We bought the whole thing in 2012, and it worked hand in glove with Nelvana, our animation studio. But when we really realized that, we're focused on, the ad-supported video business, whether that is linear channels or digital video, and we felt it was the right time to really monetize that asset and put Toon Boom in potentially even stronger hands to get into the next layer of their growth internationally. Is there
any concern, though, that you would be losing some of that diversification by focusing in?
Not really. The fact of the matter is we got 10 times plus multiple on the sale. We're trading for less than 5 currently. It's accretive, and it accelerates our ambition to continue to deleverage our balance sheet. So in the scheme of things, we're balancing our growth strategies on premium digital video with our desire to get our debt down to below 2.5 times net debt to segment profit.
Where are you with the sort of evaluation of the assets that you have? Could there be other pieces to this puzzle that you end up selling off?
At this point, I think the Toon Boom was the primary opportunity, that sale. We're really focused on continuing to find efficiencies in our business, as I know Bell Media is too. We're all doing that right now. We're all contending with a challenging advertising marketplace. And so, we have exciting investment areas we're focused on, but probably Toon Boom was the real opportunity that was right in front of us, and the team moved quickly to take advantage of that.
Tell us more about the advertising environment that you're seeing right now, because I know you've talked in length about it, being this advertising recession, and I recall you talking about how, some companies and industries didn't even need to advertise right now because the post-pandemic demand was so strong. But what are you seeing at this point?
I would describe it still as a pandemic-influenced ad recession, and it differs by every single advertising category. So, for example, during the pandemic, hard goods and durables, electronics, furniture, home renovations, cleaning supplies at home, those are all huge growth areas, lots of ad dollars flowing in there. Services, not so much. Now, of course, everybody's going out and doing things. Taylor Swift's going to generate $5 billion of activity with her tour around the world, dining out. I've gone to a concert recently, and it's fun. And so people are spending money on services. Travel, there's fewer pilots and fewer air crews, so there's fewer planes in the air. It means every single flight you're on is sold out. And so they're not having to advertise, nor are hotels. So to me, it's still sort of a recovery from the pandemic. One category that's back is automotive, and they were down for a long time because there was no semiconductor chips to build inventory. Now they're back advertising, and we're back to growth in the automotive category. So in our view, we will see a cyclical recovery in advertising once things sort of normalizes and the distortion goes away.
Now, with the proceeds from this sale, you're planning to put that towards debt.
That's correct, yes.
You've still got quite a bit of debt that you're sitting with, though. Do you want to prioritize that, or what's your plan?
Well, we during the pandemic, we did some really good work on our balance sheet. So we've laddered out our balance sheet. So we did 2 high-yield note offerings. We have a 2028 $500 million at 5%, and a 2030 $250 million at 6%. And then we also renewed and extended our term facility, so no mandatory debt repayments till 2027. So we have a pretty fortress balance sheet in that regard. But this is going to go directly to the term facility. As I say, we pay a healthy dividend at the moment of 12 cents annually, and we know that's important for our shareholders. But we also know that our credit lenders want us to pay down the bank debt, and we want to be able to be in a position to come out of this advertising cyclical recovery in a stronger place from both a cost structure and from a balance sheet point of view.
When do you think that will be?
That is the maybe $64 million question, Jacqueline.
Right.
I don't know. There's no signs right now of any emergent recovery. I speak to my counterparts in the U.S. Media companies often. People are all very optimistic. That we've all seen it before. It feels like prior advertising recessions get down 10%, ticks along there. It has stabilized now, but we haven't seen any kind of a pulse yet of the thing coming back. We know that when it comes back really quickly. So we want to be in a position to take advantage of that. But right now, the visibility remains quite limited.
Depending on how long it does last, does that mean that you might have to, make other changes, trims, cutting jobs, that sort of thing?
I think one of the things that we're working really hard on right now is working to help redefine the regulatory obligations of broadcasters in Canada. We all have required spending based on the 1991 Broadcasting Act, which no longer makes any sense from a business perspective. We have Bill C-11 now, the Online Streaming Act, which is in the beginnings of proceedings with the CRTC. That's a lot of our focus right now, is making sure that broadcasters like your parent company and Corus, not leveling the playing field means not only getting the foreign internet media broadcaster to contribute the way we have to, it also means reducing our obligations in Canada and giving us more flexibility to spend our Canadian production expenditures on things that drive our strategy. So that's what we're focused on too.
And Doug, just quickly, another big issue that's looming here is the possibility of an actor strike. There's the writer strike that's ongoing, but this actor strike as well. What sort of impact do you see that having?
I'm of two minds. I think it's important for the folks that contribute to the creative industries to acknowledge that the business economics has changed. I mean, the days of having residuals and syndication on TV shows, those are different. The streamers have changed the business models. I think that has to be addressed. But they can't go backwards to the way it used to be. There's got to be some new third way, which is important. From our perspective, we've been working with our simulcast partners, CBS, NBCU, to build a schedule, knowing that the scripted content may not be there. So we have a lot of great unscripted content. We have Survivor, Big Brother Canada, The Wall, I Can See Your Voice, those kind of shows which will debut in the fall calendar. We have a lot of the Peacock content, which we're exclusively broadcasting in Canada at Corus. And we also have a whole bunch of our Canadian programming. So we're going to be able to be fine in the fall. How prolonged it goes, I think, is nobody knows. But it's another distortion out there in our space, no doubt.